Hi everyone. In the previous videos, we discussed investments in debt securities. In the next series of videos, we're going to discuss investments in equity securities. In this video, we'll talk about an equity security where the investor does not have significant influence over the investee. The critical events over the life of an investment in the equity of another company, such as shares of common stock, include purchasing the equity security, receiving dividends from some equity securities, not all companies pay dividends, holding the investment during periods in which the investment's fair value changes, and thus incurring unrealized holding gains and losses since the security has not been sold, and selling the investment, and thus incurring realized gains and losses since the security has been sold and the gains and losses were actually incurred. Also, equity investors typically get to vote on key decisions made by the company, such as who will serve on the company's board of directors. Each share of common stock gets a vote. So if an equity investor owns enough shares, the investor has enough votes to influence the operations of the company whose shares they own. Therefore, accounting for equity investments also considers the extent to which the investor can influence the activities of the investee. Illustration 1212 in your textbook shows 3 reporting categories for equity investments. This is a very useful illustration and should be flagged for future reference. As shown in the illustration, we use 3 different approaches to account for equity investments. First, we'll discuss the fair value through net income approach that is used when the investor lacks significant influence over the investee. The lack of significant influence is usually assumed when the investor owns less than 20% of the voting stock of the corporation. Then we'll cover the equity method that's used when the investor does have significant influence. Significant influence is assumed when the investor owns at least 20% of the voting stock of the corporation, but less than 50%. In this class, we won't cover consolidation accounting, which is used when the investor controls the investee by owning 50% or more of the voting stock. That is a topic beyond the scope of this class. However, we will discuss consolidations briefly when we discuss the equity method, as the 2 approaches are related. If an investor owns less than 20% of the voting shares of an investee, the investor is typically presumed to not have significant influence over the investee. The investor simply hopes to receive dividends and hopes that the value of the shares appreciate over time, but they can't really tell the investee company what to do. Until very recently, those sorts of equity investments were accounted for as either trading securities or available for sale investments, just like we would treat debt investments that weren't intended to be held for maturity. However, starting in 2018, investors are no longer allowed to use the available for sale approach for equity investments. Instead, all equity investments are accounted for like trading securities using an approach commonly referred to as fair value through net income. This means that equity investments for which the investor lacks significant influence are reported in the same way we report debt investments that are classified as trading securities. The equity investments are carried at fair value in the balance sheet, with unrealized holding gains and losses recognized in net income in whatever period they occur. Let's take a look at some transactions that happen between United, and Argent. The following events during 21 and 22 pertain to United's investment in the common stock of Argent. In this example, the United owns less than 20% of the voting shares. So these are the transactions that happened, and we're going to go through one by one and talk about how we record the journal entries. On July 1st, 2021, United purchased Argent Inc. common stock for $1,500,000. Well, it's a pretty simple journal entry. Debit investment in equity securities, credit cash for $1,500,000. On December 31st, 2021, United received $75,000 cash dividend from Argent. The journal entry to record the dividend is debit cash, credit dividend revenue, $75,000. On December 31st, 2021, the fair value of the Argent stock had declined to $1,450,000. United must calculate the balance in the fair value adjustment account by comparing the $1,500,000 cost with the $1,450,000 fair value. United will then record unrealized gain or loss on the investment in an amount sufficient to move the existing balance in the fair value account to its proper ending balance. In this case, the value of Argent stock declined by $50,000. So the fair value adjustment account must have a credit balance of $50,000. Because no previous entries had been made to the fair value account, its beginning balance was zero. Therefore, United must credit the account by $50,000 to get its balance to the proper $50,000 credit balance. The offsetting debit is posted to loss on investments in the income statement. So, debit loss on investments in the income statement, $50,000. Credit fair value adjustment, $50,000. Notice nothing here is recorded to other comprehensive income. On January 5th, 2022, United sells all of its Argent stock for $1,446,000. First, United must record in net income any unrealized holding gains or losses that occurred during 2022 prior to the sale. The fair value of the Argent stock was $1,450,000 at December 31st, and as of January 5th, the fair value had decreased even further to $1,446,000. Therefore, at January 5th, the ending balance of the fair value account needs to have a $54,000 credit balance. The account had a beginning balance of $50,000 credit, so the account needs to be further credited by $4,000 to bring its ending credit balance up to the necessary credit balance. So the first journal entry that is necessary on the date of sale is to debit loss on investments, which is recorded in net income, and a credit to the fair value adjustment account, $4,000. The second journal entry United must make is on the date of sale is to record the receipt of cash and remove the amounts associated with the Argent investment from the relevant balance sheet accounts. So that journal entry is debit cash $1,446,000, debit fair value adjustment account $54,000 to get that account totally off the books, and credit investment in equity securities $1,500,000 to get that account totally off the books. Because United carried the investment at fair value as of the date of sale and had already included in net income the entire loss associated with the investment, there is no realized gain or loss to recognize in the sale journal entry. Over the life of the investment, United has recorded a total loss of $54,000, but the loss is spread over the life of the investment, recognized as the fair value of the investment changes. The 2021 loss recognized in net income was $50,000, and the 2022 loss recognized in net income was $4,000. Therefore, the total loss recognized over the 2-year period was $54,000. We already discussed the income statement presentation for an investment for which the investor does not have significant influence. This kind of equity could be classified as either a current investment or a non-current investment in the balance sheet. If the equity investment that is held for more than a long-term purpose, it should be classified as non-current. Otherwise, it should be classified as a current asset. Equity investments for which the investor lacks significant influence that are held with an intent for short-term profit are normally treated as operating activities in the cash flow statement. Otherwise, they are classified as investing activities in the statement of cash flows. Don't forget about the notes to the financial statement. In the notes to the financial statements, the investor should disclose the portion of unrealized holding gains and losses for the period that relate to any equity securities still held by the company at the end of the reporting period. Also, the notes should provide information about how the carrying value was calculated for equity investments for a fair value that is not readily determinable. The easiest way to get a readily determinable fair value on a stock is if it's a publicly traded company, the stock's going to be traded on the stock market and there'll be a value in the stock market reports. But if it's not a publicly traded company, then we have to establish fair value. How is that done? And that's what this note is all about. The note has to give information about how the carrying value is calculated if the fair value is not readily determinable. Here's another concept check problem for you. Please pause your video while you consider the answer to the following question. Which of the following is false about the sale of an equity investment? Is it A, all changes in equity securities fair value are reported in earnings as they occur, therefore the sale of an equity security does not necessarily give rise to gain or loss? Or is it B, a debit to cash is recorded for the sales proceeds? Or C, equity securities should be reported on the balance sheet at fair value until they are sold? Or D, equity securities should be reported on the balance sheet at amortized cost after it is sold? When you have your answer, please start the video again to check your work. A, B, and C are true. Therefore, the one that is false is D. Equity securities should not be reported on the balance sheet at all after they have been sold. Well, that's it for this video. In our next video, we'll discuss the accounting for equity investments when the investor acquires significant influence over the investee.